the silent turning point in American banking. It began without headlines, without panic, without the dramatic upheaval that usually marks a financial revolution. Instead, it unfolded quietly, through scattered decisions, subtle shifts, and a slow realization that the country's banking system was transforming in ways few people fully understood. No crisis forced a change. No single event demanded it. Yet the shift that emerged would alter the nation more profoundly than many of its loudest financial battles. To understand why this moment still echoes today, we must return to a period when America's economy was stabilizing after years of turmoil. Recoveries had come and gone. Crises had challenged assumptions. And policymakers, bankers, and citizens alike found themselves asking the same question. How do you build a system strong enough to survive both prosperity and panic? The answer didn't arrive in the form of sweeping laws or dramatic announcements. Instead, it emerged from a patchwork of reforms, quiet innovations, and gradual adjustments in how banks operated. Small steps, easy to overlook individually, began reshaping the very structure of American finance. Lending standards tightened, clearing practices improved, regional networks strengthened their coordination, and the system that once felt fragile started to show signs of resilience. In small towns, people noticed fewer bank failures. In cities, businesses found credit more predictable. Investors sensed the financial world becoming less chaotic, more disciplined. But beneath this sense of stability lay a deeper transformation, one that was invisible to most, yet unmistakable to those watching closely. Banks were learning to share risk. Regulators were learning to anticipate danger. And the government, once reluctant to intervene, began taking a more active role in guiding the system's evolution. It wasn't dominance. It wasn't control. It was something new. Cooperation, caution, and a willingness to move beyond old assumptions. Yet even as progress took shape, some questioned whether the changes went far enough. Others wondered if the system was becoming too rigid, too dependent on unseen mechanisms that the public did not fully understand. And in that tension, the earliest hints of conflict began to form. The turning point had arrived quietly, but its consequences were only beginning to reveal themselves. The quiet transformation soon exposed its first signs of strain. What had felt like progress to some began to feel like intrusion to others. As new regulations took shape and oversight expanded, bankers who once operated with wide discretion found themselves constrained in ways they had never experienced. The reforms were subtle, but their impact was unmistakable. The balance of power was shifting. Lending practices grew more uniform. Banks that had built their reputations on flexible, relationship-driven credit now had to justify decisions with data, documentation, and oversight. Some institutions adapted quickly. Others struggled. What had once been a system shaped by local judgment was evolving into a network guided by broader national standards. And while this created stability, it also created resistance. Behind the scenes, small disagreements sharpened. Bank presidents questioned whether regulators understood the realities of local economies. Regulators insisted the new framework was essential to preventing future crises. Neither side wanted confrontation, but the unease between them deepened with every new requirement, every adjustment in policy, every shift in how risk was evaluated. Meanwhile, the public experienced the consequences in subtle ways. Credit became more predictable, but also harder to access for those who had once relied on leniency. Businesses accustomed to rapid approval now faced slower decisions. Families who hoped to secure loans encountered questions and paperwork that didn't exist a few years earlier. These changes weren't catastrophic, but they were noticeable, and they signaled that the banking world was no longer defined by familiarity, but by caution. In financial centers, analysts debated whether the reforms signaled a stronger future or a quiet tightening of control. Some praised the discipline emerging across the system, pointing to reduced failures and more measured growth. Others warned that a cautious system could become stagnant, unable to respond to rapid change or local needs. The tension was intellectual at first, but beneath the surface, it carried emotional weight. Inside boardrooms, frustrations simmered. Bankers felt watched, evaluated, second-guessed. Regulators felt pressure to enforce new standards while facing criticism from all sides. Each group believed it was protecting the nation. Each believed the other lacked perspective. The distance between them widened even as they attempted to work together. And through all of this, the public, mostly unaware of the shifting power dynamics, felt a growing sense that something in the financial world had changed. Their banks were safer, yes, but they were also different, less personal, less flexible, less familiar. The early conflict had taken shape, not in dramatic confrontations, but in the quiet friction of competing visions for the nation's future. A system that had once thrived on volatility was learning discipline. A system that had once valued independence was learning interdependence. And the real question was beginning to form. How much change could the system absorb before stability turned into strain? The tension that had simmered beneath the surface finally began to surface in unmistakable ways. What had once been minor disagreements between bankers and regulators now evolved into a broader struggle over identity, authority, and the future of American finance. The system that had quietly strengthened itself was now confronting the unintended consequences of its own evolution. Banks felt the pressure first. Their margins tightened as new rules limited speculative lending and required higher reserves. Institutions that thrived on flexibility found themselves constrained by frameworks designed for consistency. In boardrooms across the country, executives debated how to adapt. Some argued that the changes were necessary to prevent future crises. Others insisted the reforms were suffocating innovation and punishing institutions that had weathered storms for decades without failing. The emotional weight of these debates grew heavier by the month. Some bankers felt as though the system they had helped build was being taken from them. Others feared that resisting the reforms would brand them as reckless. Tensions rose, not because anyone wanted confrontation, but because everyone felt cornered by a system that was no longer familiar. Regulators, for their part, felt the pressure just as intensely. They were tasked with enforcing a new standard of safety in an industry defined by fluctuation and risk. Each time they tightened a rule or rejected a bank's proposal, criticism followed. They were accused of overreach, bureaucracy, and ignorance of local conditions. Yet behind closed doors, many admitted feeling the same uncertainty as the bankers. They knew the system needed discipline, but they also feared stifling the adaptability that had long been one of America's strengths. Meanwhile, the effects rippled outward. Businesses found credit increasingly difficult to secure. Startups struggled to obtain even modest loans. Farmers faced stricter terms for seasonal financing. The system was safer, but it was also slower, harder, and more rigid. And with every delay, every denial, public frustration grew. Markets reacted to the shifting landscape with volatility. Investors interpreted each regulatory announcement as a sign of deeper struggle. Stocks swung in response to rumors about new rules. Financial commentators warned that the country risked trading one kind of instability for another, a visible crisis for an invisible one. The emotional peak built gradually but unmistakably. A coalition of regional banks publicly criticized the new regime, claiming it undermined local economies. Days later, a group of regulators countered with a statement warning that resistance to reform endangered national stability. The exchange ignited a public debate, one that spilled into newspapers, political speeches, and boardrooms across the country. Suddenly, the quiet transformation no longer felt quiet. It felt like a battle. Not a battle fought with dramatic collapses or frantic panics, but with words, policies, and the fear that the system was bending toward an uncertain future. A future in which stability might come at the cost of flexibility and safety at the cost of growth. As the conflict reached its emotional height, one truth became impossible to ignore. The nation was not just redefining how banks operated. It was redefining the very meaning of trust, risk, and financial freedom. And the breaking point was now closer than ever. The climax arrived with decision that would ripple across the entire financial landscape. The government enacted a sweeping reform package that formalized the quiet changes of the past decade and cemented a new era of oversight. It was a declaration, not of war, but a direction. A clear signal that the nation had chosen stability over improvisation, discipline over autonomy, and systemic safety over local discretion. The moment the legislation passed, reactions surged from every corner of the country. Bankers who had resisted the new framework voiced outrage, warning that the reforms would choke innovation and burden communities that depended on flexible credit. Others breathed a sigh of relief, convinced that stronger guardrails would protect the nation from future collapses. But regardless of stance, no one doubted the magnitude of what had just occurred. The silent turning point had become official. Inside regulatory offices, a quiet resolve settled. Officials understood that enforcing these new standards would be difficult. They knew they would face criticism, pushback, and scrutiny from industries accustomed to operating with far more independence. But they also recognized the necessity. Crises had revealed the cost of leaving too much to chance. The new system couldn't promise perfection, but it could promise resilience. The aftermath brought changes both visible and subtle. Banks restructured their operations. Regional branches adapted to uniform standards. Lending slowed temporarily as institutions adjusted, then stabilized under clearer rules. Families noticed fewer sudden bank failures. Businesses found credit more predictable. Even if harder to obtain, investors, once anxious, began to rebuild their confidence in a system that now felt less like a gamble and more like a partnership between private ambition and public responsibility. Yet the most profound shift was psychological. The nation realized that trust in banking could not be rebuilt with hope alone. It required structure, rules, cooperation, and accountability that reached beyond individual institutions. The reforms created a new compact between banks and the public. Safety in exchange for transparency, reliability in exchange for regulation. The climax faded into a quiet, reflective resolution, not triumphant, not mournful, simply clear. The country had stepped into a new financial era, one crafted not through crisis, but through determination to prevent the next one. Finance, the nation learned, does not transform only in moments' collapse. Sometimes it evolves in silence, through steady hands and deliberate choices. Sometimes the smallest shift in perspective becomes the beginning of a new future.